you are trying to master ICT, then you have come to the correct place. Welcome to my series, which is the blueprint to mastering ICT concepts. The purpose of this series is to help traders navigate learning the trading algorithm and smart money concepts developed by the InnerCircleTrader. I plan to create multiple PDF files and videos on every single ICT concept that has been taught and create a forever library on this YouTube channel full of information. Let's get started. Welcome to part number 1 of the series. In this episode, which is the first episode, I'm going to be discussing fair value gaps. Let's get to the PDF. So, introduction to fair value gaps. So what is a fair value gap? By definition, a fair value gap is an imbalance in price. So it is an imbalanced price range that is considered inefficient to one side of the marketplace, which is sellers or buyers. So meaning only sell side or buy side delivery was offered in this range. So basically we have a price range from a certain high or low, and inside this range, it is inefficient to either buyers or sellers. Since only one side of the market was offered in this price range, there is a gap of fair value for the other side of the marketplace. This gap can be viewed through both buy side and sell side delivery. So I will demonstrate this. As you can see here, we have 3 candles moving higher, and this candle right here is what creates the fair value gap. In this candle, we have a single pass of buy side delivery, meaning it is inefficient to sellers because there is no sell side delivery. And on the opposite side, we have a single pass of sell side delivery, meaning there was no buy side delivery offered in this price range. Therefore, it is a gap of fair value or a imbalance and inefficient to buyers. So this is a fair value gap or a buy side imbalance, sell side imbalance. So how do you identify a fair value gap? So a bullish fair value gap or a buy side imbalance is a 3 candlestick pattern where the first candlestick high does not overlap with the third candlestick low. Now stay with me. The sell side imbalance or a bearish fair value gap is a 3 candle pattern where the first candle low does not overlap with the third candle high. So let's demonstrate. In this bullish fair value gap example, we have a 3 candlestick pattern where the first candlestick's high does not overlap with the third candlestick's low. This creates a price range from this high to this low, which is called a fair value gap. Because of this candle's single pass of buy side delivery, we created a gap between this first candle's high, this third candle's low, which creates the inefficiency in price, the inefficient to sellers. So this is a bullish gap, a buy side imbalance, or a fair value gap, bullish fair value gap. Now on the other side, we have 3 candlestick pattern moving lower, and we have the first candlestick's low not overlapping with the third candlestick's high. This creates an imbalance between this candle's low and this candle's high, which creates a gap because of this candle's sell side delivery. So because this and this do not overlap, we have an imbalance or a gap of fair value because there was no buy side delivery. It is a single pass of sell side delivery. So this gap is referred to a bearish gap, or a sell side imbalance, or a bearish fair value gap. Why do these fair value gaps form? Fair value gaps are left behind in price action as an algorithmic signature that help us understand direction and order flow. So you can use these fair value gaps to help determine where price is going to go and navigate how it's going to get there. Price is also drawn to these levels, like I just said, and in order to offer efficient price delivery to both sides. So we can't simply have a single pass of buy side delivery up and up and up forever. That is inefficient delivery. We need to come back and offer pricing to sellers in this price range because it's efficient to do so that way. And the market algorithm delivers efficient price. So using this information, we can use fair value gaps as an objective for potential trades or for trade entries, because we know price is likely to come back into this fair value gap, and we're going to see something based off of that. So for example, here you have, let's say, a lower time frame imbalance, in this case a bullish imbalance or a buy side imbalance, bullish fair value gap, whatever you want to call it. You can see the market comes back into it to offer sell side delivery because it is a gap of fair value. So in this move lower, we are offering fair value. and then price reacts off of that level and it goes higher towards a higher time frame fair value gap or imbalance. So you can see how the market will use this gap to trade to another gap perhaps. And the same thing here on the other side, we trade back offering buy side delivery because there is a gap inefficient delivery here. So we trade back into it and then the market rejects and it goes towards another objective, which is a higher time frame gap that needs to be filled. We're going to talk about high probability and low probability fair value gaps. So low probability would just be not having these criteria. So a high probability fair value gap, it forms from a key level, meaning we touch into a key level where you're expecting some sort of reaction, and then we form a fair value gap higher or lower. It forms with displacement, right? It's strong. It's not very, the size of the gap does not matter, but the displacement from the level forming the gap matters. It is higher probability if we take opposing liquidity out of the marketplace before forming the gap, if it forms in confluence with other levels. So if you have a fair value gap aligning with some other levels, that is a higher probability fair value gap. And then finally, it forms in the direction of the drawn liquidity, meaning the fair value gap is forming within your bias. And I will give you guys the final example. So as you can see here, I'm going to demonstrate a high probability fair value gap for both sides. So focus on my cursor. Here we have price coming down into a key level, also sweeping this liquidity, right? And you can see this long wick forming the rejection. And immediately after, we get displacement higher, forming a bullish fair value gap. The displacement is outlined through the break of this old high. So we're making a higher high. We see a nice body, which is valid, very strong valid indicator for displacement, and we create that bullish fair value gap. We have a drawn liquidity higher, which means this fair value gap is a high probability fair value gap. Now on the other side, you can see the market comes down and then up into a key level, sweeping liquidity. We get a large wick showing that it's potentially rejecting, and then we get that bearish fair value gap or sell side imbalance, which forms because of this displacement. We get a market structure shift because we are breaking below this old low, and we create this imbalance. We also have a drawn liquidity lower, meaning that this is a high probability bearish fair value gap. Okay, so we're going to get into our first example where we're talking about fair value gaps and actually using them on the actual charts. So over here, we have a bearish direction. So let's say we are aiming for this potential drawn liquidity, and we can see this large displacement of a bearish fair value gap. Okay, so seeing this bearish fair value gap, we can potentially expect lower prices. We can see what the market does here is it draws towards that fair value gap right here. We actually trade into it, and then we get another candle higher into this fair value gap, and you can see we get that immediate displacement lower, and eventually we go towards the drawn liquidity. So this bearish fair value gap right here could have been a good short candidate because of the bearish direction, the drawn liquidity, the displacement. Notice the market actually also drew up into the fair value gap. So going back to the PDF, we talk about how the market is drawn to these imbalances, and then if you have the correct direction, you can expect a reaction lower towards the drawn liquidity. The market is coming back up here to offer efficient price delivery. Okay, over here we have our next example. What I want to take your attention to is this 4-hour bearish fair value gap, which is resting in premium of this price range right here. So what do we have here? And I'll just annotate this as discounted premium. So we have a premium array over here, which is this bearish fair value gap. And you can see the market has created this 4-hour bullish fair value gap. We have a large displacement. We came back into it here, and we came back into it here. So what I want to take your attention to is we have a potential objective of a gap right here, and we have a potential candidate to take us there, which is this bullish gap here. So trading this bullish gap to this bearish gap, I'm going to zoom into the 15-minute chart, and I want you to look closely what happens when we trade into that 4-hour gap. So this green box is that 4-hour bullish fair value gap, and over here we have a 15-minute bullish fair value gap. So you can see here on the 15-minute chart, once we trade into that 4-hour fair value gap, we now have a P level, which we talked about in our checklist for high probability fair value gaps. We have a bullish fair value gap on the 15-minute chart, and as you can see, price comes back into the 15-minute fair value gap, and then eventually we'll reach that 4-hour premium fair value gap. Now, obviously, if you were to take a trade like this, you do not have to hold it, right? The idea is simply is this a higher probability bullish fair value gap? And the answer is yes. We have displacement on the higher time frame as well as the lower time frame. When the gap is created, we trade back into the gap. We are sweeping out liquidity over here. We have a very strong displacement. We have converging levels at this price point. We trade back into it, and then we trade higher. So this is a high probability bullish fair value gap. And you can see how you can use a higher time frame bullish fair value gap as an objective. And once we trade into a higher time frame fair value gap, you can zoom into a lower time frame chart, and then again wait for your bullish fair value gap as a reactionary measure to trade towards your objective. Okay, now I'm going to give you guys one more example, and we have an interesting scenario right here. So we have a bearish fair value gap right here, right? So this is a bearish fair value gap or a sell side imbalance. And over here, we have a bullish fair value gap. So what is a potential scenario that's happening over here? So if we are bullish, we want to see this bullish fair value gap deliver higher prices. And how could we potentially reach this bullish fair value gap? Well, let's see. So initially, we trade higher into this bearish fair value gap. Now, before continuing, I want to outline, if you were to zoom into a lower time frame chart, you actually get a bearish fair value gap right here and a bearish fair value gap right here. And now remember, this green box is a 15-minute bullish fair value gap. And if you play this trade idea out, so you actually could have shorted right here from this bearish fair value gap, which is playing off of the 15-minute bearish fair value gap. And then where are we aiming for? Well, we have this 15-minute bullish fair value gap. So see how you can play from one fair value gap to another. And now we're inside this bullish fair value gap and we are bullish, we can actually look for longs. So if you were to zoom in on, again, the 1-minute chart, playing off of this green box, which is the 15-minute bullish fair value gap, you can see we actually form another bullish fair value gap. We trade back into it, and then the market trades higher and higher and higher. It's going to take some time, but eventually it'll get there. And obviously there are other fair value gaps being formed along the way, but we are primarily just talking about these ones that form with displacement, with key levels, with a higher time frame objective in mind, and in direction with our bias. And you can see how using fair value gaps and different time frames, you can navigate where price is likely to go and how to take potential entries to trade that objective. I hope you guys enjoyed the video. If you want to subscribe, like, and leave a comment, I will read every single comment. I appreciate all your support. Until next time, take care.